The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. The Air Force Research Laboratory is partnering with Google Cloud using AI to accelerate defense research for air, space, and cyberspace forces. This is a new era of American innovation. Find out more at g.co/American innovation.
Reality radio for a really great future. We're talking real money.
Well, wait, I'm kind of confused. Tom, there's somebody else in the studio today. Wait, are we doing a podcast? Is this guy, I get it. This guy's a singing telegram. You got me a singing, Tom, my birthday's not till June.
You stole my thunder, my best line, but that's okay. Our guest.
Oh, your best line.
I know. On Talking Real Money.
Is this guy going to sing to me?
Not you. And we don't have a lot of guests, as you know, never. But because he's so distinguished, he's been around the industry forever, and he always has something important to say. He's a vice president with Dimensional Funds, a fund family that we have known and worked with for darn near 30 years now, and somebody that we've had at Retire Meet, other places. Weston Wellington, thank you for making time out of your trip to Seattle and venturing to the Talking Real Money studios. Good to see you again.
Great to be here.
All right, but I will start with the most difficult question. What is going on, man? The market's it's up 10% one day, down 5% the next day, and we get here to mid-April when this is, or late April when this is being recorded, and kind of looks like we started the year. I mean, how do we take all this?
Volatility is just a sign of uncertainty.
And so there's a lot of uncertainties.
The world's an uncertain place, and I think you could make a strong case that in the recent weeks or months, it's gotten more uncertain. And so that volatility is just it's a barometer, a reflection of that uncertainty. We don't really know what the effect of tariffs or lack of tariffs might be. We don't know if government policy will change, and it might change quickly. And so you see prices jump or the prices fall, and you have millions upon millions of investors all trying to figure out what the right price to pay for ownership in a company. And when the outlook gets more uncertain, you tend to see more volatility. This is nothing particularly new. It's just the types of uncertainty, whether it's unexpected military adventures or unexpected events of any sort, political, economic. Markets are always grappling, trying to price securities every day so they have positive expected returns.
Don't we essentially need volatility, though, in the market for the market to make us money? If we had no volatility, wouldn't the stock market be the bond market?
That's a good way of thinking about it. That's why we say volatility is just a reflection of that uncertainty. With bonds, you have a far more certain payoff. With stocks, the payoff is much more uncertain. We don't know what the dividends, if any, might be on any particular company. We have a pretty good idea if the U.S. government is promising us 5% interest payments on a long-term bond. Those are very predictable cash flows. Cash flows are a lot less predictable for companies. So,
well, it's like a job. If you're taking on a job that pays a lot of money, your expectation is going to be you're either taking more risk or you're going to have to work a heck of a lot harder. And the volatility is the price we pay to play.
Right.
Okay. So, but here we are again. We're through basically 4 months of April. Market's gone up, market's gone down. Well, we could get into a little bit about the U.S. versus international. But I think the more interesting point is something that you have spoken about for decades, and that is around the media's role in all this. Because you used to do a piece that talked about investment pornography, for example, kind of all the messages that are sent out. How big a role, and is it worse today than when you started with Dimensional? Gosh, is that 30 years ago? Does the media play a bigger part in making people freaked out about the ups and downs?
I don't want to demonize the media, but they have a business to run. You have to get the attention of potential readers if they're going to sell newspapers or magazines. If you run stories where the headline says Boy Scout helps grandma across the street, you're just not going to sell as many newspapers as if you have news about an airline crash or a horrific murder or a stock market debacle. It's just the nature of the beast. And so it behooves investors to understand that if I'm going to be trying to rearrange and evaluate my portfolio every day in response to news events, I'm going to drive myself crazy.
But the financial press is notorious for not just reporting news and exciting news, because they are trying to sell their product, but they're notorious for giving advice on what to do. Buy now, sell now, do this. How should investors react to all of that advice they're being given on an ongoing minute-to-minute basis in some cases?
They should think about the distinction between changes in your personal situation compared to changes in the world at large. The news media are going to give you an endless number of reasons, positive or negative, to take action. But you should only be changing your portfolio in response to changes in your situation. Maybe you lose your job. Maybe you go through a divorce or whatever. That might be a reason to change your portfolio. Changing your portfolio in response to a news headline really doesn't make any sense, because there's always going to be something to be positive about or negative about. That's just the nature of the world. There are thousands of things happening every day. There are thousands of companies, some of which are prospering more than others. You torture yourself trying to reform your portfolio in response to news events. That's just a recipe for pain, because you're always going to be anxious that did you make the right move? Should you have sold instead of buying, et cetera, et cetera. And there's an abundance of evidence that investors would be much better off to just decide how big a helping of somewhat riskier assets with potentially higher returns belong in my portfolio, and then change that allocation only when your personal situation changes, not when the world at large appears to be changing. That's a very simple observation, but it's difficult to implement for many people.
We do find that. I was going back thinking by Weston Wellington stories. Now, I think I heard you at Dimensional when I first went to Santa Monica in 1997, and that's dating myself. But later on,
you're older than that, Tom.
Later on, I believe you were the one who gave the talk about looking at the magazines and the headlines, and you compared the expected return of Hormel, which was in the business of making spam, not the stuff you get in your inbox,
right,
but the meat,
the real spam, the edible spam,
versus Motorola, which had gotten in the business of making cell phones. I don't even know if Motorola makes cell phones or mobile phones anymore. But
no, they don't.
You were saying, which would you have preferred to buy in like 2000 or something like that? And
right.
I haven't looked at. I didn't get a chance to look at the numbers now.
Well, Motorola kind of split up into multiple companies, and they aren't really for a while. It was a very useful example because I sort of imagined a situation where your fairy godmother appears to you in whatever it was, the early 1980s, and said, "This cell phone gadget, mobile phone, may look like a toy, but it's going to revolutionize.
Yeah,
you'll have third graders chattering on these things in the future."
Ouch.
Oh, well, thank you, fairy godmother. And then I'd say, now, suppose you had been given the choice of investing in Motorola at the dawn of the era of mobile phones, or spam, which is, I'm not sure how officially they describe it, but I'm not even sure at lunch meat. It's supposed to be edible, but I used to eat quite a lot of it when I was a youngster.
Wow.
And I think most people would probably concluded, canned luncheon meat as an investment. I want something much more exciting. And your fairy godmother assures you that these mobile phones will be sold by the millions. Well, it just seems like it would be a slam dunk. Let's buy Motorola shares and forget about Hormel. But fast forward, whatever it was, the next 15 20 years, and right, Hormel shares had done quite a lot better than Motorola.
It just shows, I mean, to me, it says everything you need to know about buying individual stocks, which
Right.
so many people do still. They believe in it. I mean, and this year, you watch the Magnificent Seven lose 20% of its value in just a few months. What is Dimensional's take on owning individual equities? Or does the firm have a stance on that?
Well, our belief is that you'll most likely put the odds in your favor by diversifying as broadly as possible. Nobel laureate Merton Miller, who unfortunately is no longer with us, but he used to say, diversification is your buddy. Individual stocks are highly risky. The more you diversify, you add another stock, 5 stocks, 10 stocks, 50 stocks, 500 stocks, that overall volatility goes down dramatically. But the expected return doesn't change. The expected return on any single stock is about the same as the market return. So it's the closest thing to a free lunch in all of economics, diversification. You ought to eat a lot of it.
Not spam, though. I'll tell you
Not
that much.
spam, diversification.
Yeah, but it's interesting that in the current climate, some are saying that even portfolio diversification is not enough to save us. That now there are new things. There are better things than just overweighting for value or small or whatever. That we should be now more heavily weighted into alternative investments. That there are really truly free lunches that don't involve diversification. They're market neutral. Or whatever it might be. What is your opinion and what is Dimensional's feeling about all of these newfangled alternative investments?
Well, most of them, in my experience, have been difficult to understand and have typically much higher fees that are often poorly disclosed, which sounds to me like a recipe for disappointment. Let's invest in something that I cannot explain to my grandmother, and I'm not really sure what kind of fees I'm really paying when all the fees, maybe some well disclosed, some perhaps not so well disclosed. I wish I could be a fly on the wall for some of these sales meetings where these products get pitched. And I go, who pays for the jet flights that these partners make to inspect their new investments? Am I paying as a shareholder in this fund, or this part of your company's account and you're paying for it? I'm not sure I'd like the answer.
Well, I've actually gone to some of those free dinners from guys pushing that ultimate get the returns of the market with no risk product, those indexed annuities. And I asked the question, so how do you get paid?
Pay no attention to that man. Pay no attention to him.
I said, what's the commission? What is the commission? How do you get paid? He goes, there's no commission. The insurance company pays me.
Yeah. Is right. All right. What about in terms of products? Because the industry has changed dramatically in the last 50 years. And now we're at this place, kind of an interesting place, where there's mutual funds, which people know about, and exchange traded funds, which have become much larger here the last decade. Where are you in this debate, mutual funds versus exchange traded funds? Which is the better for investors to use? Or is there a better one?
The answer is both. It just depends. Given there's some continued change in the underlying structures here, but broadly speaking, as we speak today, exchange traded funds probably make more sense for taxable accounts, and mutual funds probably, I'm oversimplifying, but make more sense for retirement accounts. And I'll use my personal situation as an example. So I typically, for my own taxable personal account, I like exchange traded funds because they tend to be a little more tax efficient. Although we're working pretty hard at Dimensional to equalize that.
I was going to stop you there because last time when I talked to somebody there, they're working hard to figure out a way that the mutual funds can have those same benefits.
But also, why would anybody want to use a mutual fund then if exchange traded funds are better? Well, think about my 401k plan, where I've got, I guess, 3 or 4 different mutual funds, all of which generate some dividend distributions throughout the year. But I'm not going to spend them. I want them reinvested immediately in more shares. And so having little tiny dribs and drabs of dividends, $29.34 quickly and costlessly reinvest it back into that mutual fund, that would be difficult to accomplish in an exchange traded fund. It's like a stock.
Yeah.
You get a cash dividend from General Motors for $89. Well, you reinvest it back in more fractional shares of General Motors. It would be cumbersome and expensive. So it just depends what type of account you have, a mutual fund or an exchange traded fund. They can have essentially identical investment characteristics, but just slightly better suited to a particular financial structure in your personal portfolio. Most people probably will wind up having each mutual funds and exchange traded funds.
Now, Weston, you, I gather, were a very precocious child as you got into the financial services industry at like age 10, because you've been in it 50 years.
So he went to Yale while working in the at the same time. Okay, that works for me.
Yeah, while in fifth grade, and no, you've been in this industry for a long time. What have been some of the biggest changes in the way the industry works? I mean, when you started in this industry, there were 8.5% loads, and
when I started in the industry in 1975, I got my license to sell securities. There was no such thing as an index mutual fund. There were index funds being used by some very large institutions,
but not to the public.
But not to the public.
Wow.
They were not available in a mutual fund form. And I still remember I was working in the Boston office for Bache and Company, which is now Prudential Bache, I think. A lot of changes. Anyhow, they had what they called the broad tape in the back of the office. It looked like a roll of paper, and it would spit out news items all day long. And people would walk by the broad tape and hey, Procter & Gamble raised the dividend or something like that. So one day in August, John McLaughlin, kind of the resident wit in the office, strolls by the broad tape. Hey, fellas, listen to this. Vanguard launches S&P 500 mutual fund. They're probably going to do a nationwide search for a high school graduate to run the portfolio. Everybody laughed. What a dumb idea. Buy all 500 stocks? I mean, obviously some companies were better than others, the thinking was.
Sure.
What a stupid idea. In 1975, that year, the 10 largest mutual funds were all actively managed, because almost all mutual funds were actively managed. Index funds really didn't exist. Fast forward to today, you see a list of the 10 largest mutual funds in America. They're all index funds. And keep in mind, none of them were ever sold or marketed via a sales commission, a sales force. It was just people understanding eventually the power of an idea, a low-cost, diversified portfolio that did better on average than all these so-called clever people picking stocks. And as I believe it was Victor Hugo, novelist, once said, you can resist the invasion of armies. You cannot resist the invasion of ideas.
Ooh,
and the ideas that invaded Wall Street were that diversification is your buddy, low cost beats high cost, and all stocks essentially have in a simplistic way of thinking about it, have the same expected return. So you should just diversify as broadly as possible and minimize your costs. And the evidence is overwhelming.
By the way, Prudential Bache became Wachovia Securities.
Oh, okay. Thank you for that
Wait for your check. It's in the mail, I'm sure. It's coming. All right. Well, so dimensional funds, again, for full disclosure, is a fund family that we've known and worked with for a long time. It is one of the fairly larger in its space, which is the part I was going to ask you about. Kind of where do you see, or how does dimensional view itself in the mutual fund / exchange traded fund atmosphere? I mean, where are you guys? How do you place yourselves in the midst of all this?
Well, we're from an investment standpoint, we're clearly in the camp of markets work well enough that it's a waste of time and money trying to hire experts to predict which stocks will do better. David Booth and Rex Singfield were both pioneers at some of the very first index funds, not mutual funds. They were just bank trust department funds at either Wells Fargo or with Rex, American National Bank in Chicago. And they were there at the very beginning when they didn't even know, well, how should we manage an index fund? How often do we reconstitute it? How do we trade most efficiently? It was all learning for them. And then Dimensional got started in 1981 when David Booth observed that all these big clients I'm working with, foundations, union funds, corporate pension funds, they tend to own stocks in the shares of big companies. And the S&P 500 index fund is a fund of big companies, roughly the 500 largest. But I learned in graduate school that the entire stock market is several thousand companies. What if I launched a fund that would invest just in small companies, kind of like an index fund, but there was no index to track at that time. It didn't exist. David went to, 5 or 10 of these big institutions who had invested with him and said, would all the managers in your pension fund buy the shares of big companies? Don't you think you should have at least some portion of your pension fund invested in small companies? And they said, well, yeah, sounds plausible. He said, but you don't have any. Well, what if I offered you a very low-cost way to get a diversified portfolio of 2,000 or 3,000 small companies in the U.S.? Would that interest you? As the story goes, out of the first 7 institutions he talked to, 4 of them said, yeah,
Wow.
that sounds like a good idea.
Sure.
And that's how the firm got started.
Wow. That's awesome. I got to ask you about a couple other things before we let you go. The impact of AI on our business. What do you
Impact
think?
of AI.
Yeah, I mean, well, Don now uses it. He barely even comes up with any of his own stuff anymore. I mean, it's like just
No, I'm
here's what
not.
they say.
I'm not really me.
It's
right
not
now.
even him anymore.
I think
I recorded
AI,
my voice.
I think AI, artificial intelligence,
Pardon
is a
me.
really intriguing idea that will probably have lots of ramifications. But the question we often get from investors is, well, does Dimensional use or will you use AI to help manage your portfolios?
Sure.
And the answer is, we are actually already using something that we believe is even more powerful. Another version of AI. It's not artificial intelligence. It's aggregated intelligence.
All the knowledge.
It's all the knowledge.
Yeah.
Which basically is what AI is.
Well, but
It's aggregated knowledge.
It's aggregated knowledge, but only that can be found somewhere.
Right.
There's lots of additional knowledge that is stored in people's brains, market participants. And as Merton Miller used to say, Nobel laureate who used to be a fund director, everybody out there has some tidbit of information. The job of the capital markets is to incentivize people by offering a bribe, so to speak. You have some information that might be useful about the prospects for this or that company. Maybe you work there. Maybe you're on the loading dock and you can see when the orders are coming through, when they're not. Everybody has some little tidbit of information. The market tries to garner all those little tidbits and reflect it in security prices. And that's in real time. You don't have to wait for it to get put away onto some website
Sure.
where some AI engine can see it. Every day, people have a little bit of fresh information, and the capital markets encourage them. You have some useful information? Now, some people, well, I don't have any useful information. Everybody has some tidbit. You're the dentist in Springfield, Illinois. Who knows better than you if your patients are paying you on time or not? Nobody.
Touche. Right. Yeah.
So if we can aggregate somehow all those little tiny tidbits, that's useful. That's why using what we would call daily pricing every day, there's fresh information that gets reflected in prices. So we're already there.
All of this big picture stuff, this macro outlook, this about how markets work is great, and the fact that we all have individual intelligence and we know a lot about the things we know. One of the things we don't know, and one of the reasons so many people listen to this podcast, is because they're looking for the hows, the how to make all of this work for them. And they're going out and asking people to help them. Sometimes it's their brother-in-law. Sometimes it's somebody in the church. Sometimes it's a friend in a club. And they're getting terrible advice. You've been in the industry for a long time. How can individuals get the right advice so that they don't do the dumb things that so many investors do?
Well, they should eat two answers. One, they should try to find a professional financial advisor who
But they all say they are.
issues. That's the hard part.
Yeah.
Distinguishing a good advisor from a not so good advisor. But I also talk occasionally to Uber or taxi drivers who don't have a lot of money and probably don't have the wherewithal to hire a financial advisor to begin with. And I say, well, what you really want to do is you want to own, for the amount of money you can afford to take some risk with, invest for a long time, you should put some shares into an index fund. And I've actually had taxi drivers send me email. I opened an account and I put $1,000 to work in an index fund, because I explained to them in what I try to be is very simple language that you can get a portfolio of thousands of businesses and put that knowledge and energy to work for you. And this is how people tend to get rich in this country. They own things that grow in value.
Yeah, they don't have to do anything about it either. They don't have to run the business.
All you have to do is sit back and don't fiddle with it. So
that's the other hard part.
The other hard. Now, I'm not saying it's easy. It's often difficult to be a successful investor. And I always like to quote folks like Warren Buffett, who says, your temperament is going to be the key to your investing success, not your clever financial knowledge.
And that, by the way, gets back to having a good advisor too, stands between you and your money. All right, before we let you get away, we got to ask you about the career that really is probably the more exciting one for you, because the last time I saw you, you were in a local establishment here in Bellevue. You were going through it and singing to random people. I mean, you're just like walking up singing like happy birthday, that kind of stuff.
He really wants to be a singer, I think.
He does. Is there anything after this interview you want to sing to Dawn?
I'm going to walk the halls of your office, and if not that, the parking lot, and find somebody who's having a birthday. Okay. And I do this, if in a restaurant, I travel a lot, look over and I see a table of like 8 or 10 women.
Shockingly.
Okay. What are the odds? So I'll go over unannounced. I'm usually wearing a suit. Don't look too scary. And I'll just say, excuse me, ladies, is this a birthday celebration? 9 times out of 10.
It is.
Skeptically, they say, yes. Yeah. I go, well, who's the birthday girl? Letitia. Well, I used to ask permission. Now I just launch into it.
All right.
Happy birthday. And
was there anything you want to sing to Don now, actually having been part of this podcast?
Is it his birthday?
No, it's not.
In June.
Right. In June. It's coming up.
Okay. But I could, wait, it's a podcast. I can go back and listen. No, it's okay.
You don't have to.
You be careful what you wish for. Very hard to shut up.
I get in trouble all the time.
Yeah.
We love having you here, and we appreciate it.
I co-host with Tom. Look at what I'm doing.
Exactly what you've settled for. So thank you for all your time today. Don?
I'm good. I got to talk to Weston for a while. Thank you so much for spending some time with us and coming to visit Tom in Seattle. Not me in Florida, apparently. I'm still going to be all alone down here. But
well, I'll be happy to come travel to Florida someday. We'll go on a birthday tour or something. You know?
All right. In June when it's 98, 98.
You can watch me in action.
Yeah. Thank you so much. Weston Wellington from Dimensional Funds. Always a pleasure. Oh, I have another question for you.
Shoot.
Used to be you were the guy who always came to our events. Now every once in a while, you got this other guy, this Apollo guy?
Yeah.
Yeah. How come he's coming so often?
Well, because you don't invite me.
I'm getting the message.
There's the simple answer. My phone doesn't ring.
All right. We'll take care of that.
I figure I wore my welcome out, or I made a rude comment to some staff member.
Never.
I'm lonely. I'm lonely there in Austin. Help me out.
All right, Weston Wellington, thank you so very much. And thank you all for being a part of this episode of Talking Real Money. We so appreciate you, and we hope you'll tell your friends and family to listen more. And if you want more information on all the stuff we do here at Apello Wealth and with Talking Real Money, it's so easy to check us out at talkingrealmoney.com, talkingrealmoney.com, and join us pretty much every day as we continue to do this thing we do. It's called Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Apello Wealth. The views and strategies described may not be suitable for everyone.
This podcast is not not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor.
Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services.
Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.